Hi, this is Michael Yardney, and in this week's Property Insiders video, I'm going to have a chat with Dr. Andrew Wilson about the latest unemployment figures, about the media hype concerning Commonwealth Bank's prediction that property values may drop 30%, and about the latest consumer confidence figures. And then we're going to discuss Andrew Wilson's most recent property data to give you in-time information about what's happening to the property markets. If you'd like to get our regular updates, why not click the subscribe button below and click the little bell icon, and you'll be given an update when we bring out our weekly Property Insider videos. There's some interesting news that I'd like to discuss with Dr. Andrew Wilson in today's episode of Property Insiders. Consumer confidence has risen for the seventh week in a row, but how's this going to hold up moving forward? Also, I'd like to have a chat about the attention the media has given to Commonwealth Bank's worst case scenario, where they forecast that property values could drop 30%. But isn't this just clickbait? And the unemployment figures got the headlines this week when the Australian Bureau of Statistics released its April employment figures. But in today's fast-changing environment, timely statistics are important. This relates as much to property data as it does to the figures released by the ABS. So to get an update on the latest in-time property data, as well as his thoughts on these news items, I'm looking forward to my weekly chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Welcome, Andrew.
Thank you, Michael. Yeah, it's good to see you again.
Now, Andrew, I guess one of the themes for the last few months has been the thought that if you're going to go by the numbers, let's make sure you've got the right numbers.
Yes.
And this week, the Australian Bureau of Statistics unemployment figures were released, suggesting our unemployment rate went up to 6.2%, an increase of 1%. But Andrew, in my mind, somehow or other, the figures didn't add up. ABS estimated Australia's unemployment increased by only 100,000 people, 104,000 people. However, at the same time, the ABS estimated that there's 12,490,000 Australians employed. The number of Australians employed dropped by close to 600,000, but the unemployed only went up by 100,000. So I'm asking, what's happened to those other 400, 500,000 people who lost their jobs? What are your thoughts?
Well, look, Michael, this is the first official data we've had on the economy since the shutdown period began. Of course, it's backward looking because we don't get real-time unemployment data because of the lags in the collection process. So this really was highly anticipated because it gave us the first feel of the economic consequences of the shutdown, Michael. And even though the headline unemployment rate was just above 6% and around about 1% higher than the previous month, these were terrible numbers, Michael. And as you suggested, looking deeper into the numbers and the statistics, it reveals the actual unemployment rate, which in reality was near 10%. And I think that those economists and commentators who said that they were pleasantly surprised at what they felt was quite a reasonable result weren't looking at the data as they should have to understand what it actually meant. And you're so right. I mean, what we saw was that not only did we have a significant fall in the number of people employed, in terms of the statistical measurement, we had a record fall in the participation rate, Michael. And that's why there was that paradox between the number of employed and the number of unemployed. It's because obviously in circumstances where there were not a lot of jobs around, people gave up searching for work. And people searching for work is also a criteria for the unemployment rate. And if you give up searching for work, well, you're not included in the unemployment statistics. And of course, we weren't including the job seeker statistics as well in the unemployment rate. If we put it all together in real unemployment terms, that is including the participation rate, in other words, if we went back to where the participation rate was to the latest figures and we included the JobKeeper data, we were well over 10%, Michael. So we've lurched into the highest unemployment rate in reality since the Great Depression.
And then if you take into account the underemployed, that could bring the rate up much higher. But Andrew, there's more bad news to come, isn't there?
Well, absolutely, Michael. And of course, this will only get worse as we move forward because we have yet really not seen the real economic impact of the shutdown. That's a growing momentum outcome. We haven't seen the impact as people continue to lose their jobs, less consumption moving forward. Certainly, the prospect is for a significantly long period of weak growth and obviously poorer statistics coming through, which will work its way through to becoming self-perpetuating in terms of an economic downturn.
Well, I think your point you made a moment ago is really important. People may not realise that looking at past downturns, unemployment has taken 2 or 3 years to get back to normal figures.
Well, it is interesting to see recovery in consumer confidence, Michael, but it does reflect, I guess, more positivity about the health environment. So maybe we shouldn't be calling it consumer confidence. It's because I don't think there's a lot of consuming going on at the moment, Michael. So it's just a general society confidence, I think. And look, we should be more confident on the health front because we have flattened the curve. We're gradually getting back to work, but let's hope that we can get past what's going to be a very tough period in terms of the economic challenges.
I want to get onto that consumer confidence in a sec, but it's probably also worth reminding people that even though unemployment took a long time to get back to, let's call it normal, the property market picked up in the past much quicker than unemployment dropped. So the two are not directly linked. But getting to your point about consumer confidence, yes, this is the 7th week in a row that consumer confidence has been recovering. It's still below the 100% mark, but we're more pessimistic than we are optimistic, but it is recovering. And I think, as you say, it's related to the fact that there's light at the end of the tunnel. Restrictions are progressively easing. I guess the challenge is going to come now. How is it going to react to future negative employment and economic news?
The question is also what happens when JobKeeper finishes in September. And this is really the big picture going forward, Michael, is all this discussion, as we discussed last week, about changing tax mix, whether it be payroll tax or stamp duty, or even mentioning now raising the GST, is about moving into a new future whereby we have to tax those that still have incomes to support those that don't have incomes. Because if we move forward with political pressure to keep the JobKeeper allowances, that has to be paid for, Michael. And the only way they can pay for that in a reduced economic environment is to raise taxes. And this is what state and federal governments are flagging at the moment, obviously quite warily given the political consequences. But I think they're trying to get people used to the idea that somebody's got to pay to support what's going to be a mountain of unemployed in the community.
Some interesting times ahead. One other thing that got the headlines this week was property values are going to fall 30%. Now, there's nothing new about that. People have been forecasting this for decades. Overseas experts in particular, they come and they try to outdo each other with sensational headlines. But Andrew, this week it came from the Australia's biggest bank, the Commonwealth Bank, where they forecast property values could drop 32%. But I think it's important to understand that when the banks produce these forecasts, they produce a range for their shareholders, for their clients, that allow them to hope for the best and be prepared for the worst. But the media latched on to the worst case scenario, a 32% drop, which isn't their most likely scenario. In fact, the CBA suggested this would only occur if there was a prolonged economic downturn, the coronavirus pandemic didn't come under control, unemployment continued for a long, long time. Interestingly, the most probable scenario was for a V-shaped recovery. In other words, a short economic downturn, and house prices would only drop 11%.
Well, this is just speculation, Michael. We're all in uncharted waters. I mean, the Commonwealth methodology couldn't be based on any previous models because we don't have anything that compares in any way to what's happening now. So this is just guesswork. We don't know where house prices are going to land going forward because we don't know where the economy is going to land. We don't know what new taxes will be. We don't know what the international experience would be. And as I said at the beginning, we don't have anything to compare this particular falling off the cliff in terms of the economy with the shutdown in relation to what happens to house prices.
Well, just finishing off on the Commonwealth Bank, they wouldn't be lending you 80%, 90% loan to value ratios if they really believed property values would drop so far.
That's right.
Yeah. So let's have a look at what is happening in the market. You've produced auction clearance rates for the first time in a while, Andrew.
So look, for what it's worth, Michael, I did produce auction clearance rates. As we know, they've been very low over the last month or so, and that's a product of the record numbers of withdrawals. Those withdrawals are counted as non-sales, so they've pushed the clearance rate results down to unprecedented levels, 30%, 20% and lower. But it's not a fair indication because withdrawals were a product of those that had booked in their auctions prior to the shutdown. And as we can see from those results, they're really up and down, and they're not giving us a true indication of what's happening in the marketplace. For what it's worth, we did see, if anything, that the Sydney market was outperformed on the results any of the other markets.
Now, what's your new homes listing index showing? In other words, how many new properties are coming on the market at the moment?
Well, interesting, Michael. We've seen a stabilisation. We had a dip through the Easter period, which we traditionally get. Listings are down around 30%. These are new listings for homes coming into the market. They're down around about 30% from the beginning of the series at the beginning of March, which was the end of the normal period of transacting. And they've been quite steady, Michael, over the last week or so. And if we look at the breakdowns in terms of the capital city markets, Michael, Melbourne and Sydney have been quite steady. Brisbane's actually picked up quite a bit over the last week, but we've seen sharp declines in Adelaide and Perth. But overall, a steady result for new listings coming through. And we've seen the same thing for new sales as well. They're steady, if not actually picking up quite a bit. Must be reminded that they're both new sales and new listings are well down on their pre-coronavirus levels. And we shouldn't be surprised at that, but they are holding at the moment. And if we look at listings compared to the same period last year, they're around about 8% lower than the same period last year, but we were coming out of the federal election period a year ago, Michael.
Yeah, I was just reminded this week that it was the anniversary of the election. Look what's happened in the last 12 months. Gee, it's been an amazing 12 months. It's been a tumultuous couple of months. So I look forward to catching up with you each week and getting the update on the data and your insights into the news. Thanks for your time again, Andrew.
Thank you, Michael.